This is our Forex blog for February 28th, 2012. And like most days, we want to buy the super strong ones versus the weakest and sell the weakest versus the strong. We statistically compare each currency to every other one using multiple time frames. You can see the dollar and the yen on the top, which is what most people trade, versus all the pairs on the bottom. Each of these tools is made of 5 different statistical trend tools we've developed over the last 6 years. 3 of them measure the direction the dollar's going, whether it's up or down, and 2 of them measure the intensity of the trend. Underneath that, we have the daily, weekly, and monthly trend, which is also made up of 3 different tools for each of them. So you can see with the dollar, it's showing weakness, the daily trend's down, the weekly trend's down, the monthly trend's down. Obviously, you would prefer to sell the weak dollar because it's weak on all time frames. You don't always get time frames lining up like this. As you can see, the New Zealand was showing quite a bit of weakness earlier today. The daily trend shifted down, the weekly trend's still up, and the monthly trend's very strongly up. So you don't always get all 3 time frames lining up, but when you do, your odds go up. Of these 3 bottom time frames, I care most about the daily and the weekly. The monthly trend doesn't matter to me. It can sometimes take 2 weeks to change direction, so as an intraday trader, I don't really care about it. Some patterns that you can look for that tend to be very profitable is when you see a big explosive move up, like in the euro right here. Trends don't go up for hours and hours at a time. Sometimes they do, but very rarely. Usually you have a move up and then a move down, and then it moves up and then it moves down. If you see an explosive move up at and above our extreme 80 level, and then the pullback move has 1/2 or even less, in this case slightly less than half the momentum to the downside, this previous uptrend is very likely to continue. And even more so because the daily, weekly, monthly trend's up. When you can spot a pattern like this in the exact opposite way for another currency, like extreme weakness followed by very little strength, when you have 2 currencies both have this pattern, it doesn't happen that often, but you typically have a 80–90% likely win. So let's try to spot that pattern here at 11:30. You kind of have one here in New Zealand. Decent weakness, very little strength. It took it a little bit longer before the weakness came back in at 12, but the Euro New Zealand would have been a very high odds one to be looking for buys right around 12. Here's 12 o'clock. You got this little pullback right here, and like I said, it's a very high probability trade. We draw trend lines over the bar's high, and you can see it went from about 605, 454 all the way up. So it went up about 55 pips. So even if you got out right here, you made 20 pips in 20 minutes, or a lot of times when these strong currencies don't make at least a 2-wave move, if you would get out of it at the fib target right here, you pretty much caught the vast majority of the trade. All right, so looking at this, we have, again, a very weak dollar, very weak yen, the euro. Let's scroll back and look at it coming up to today. The euro was quite strong on most of these time frames. Notice extreme strength, very little weakness on the pullback, and the exact opposite pattern here in the yen. The euro yen was a no-brainer trade starting the day off. If you look at the currency on here, you can see the euro yen had fallen a lot yesterday. It had double bottomed here, which always adds to your probability, and then it kind of worked its way back up to the hourly moving average. One of our rules, and kind of like a filter, is below the hourly, it's more likely to go down. You're looking for sells. When it's above the hourly, you're more likely to look for buys. The only time you would ever break that rule is if you have a currency where the the weekly and monthly trend on the bottom you can see is very strongly green. And so if you see a double bottom in one of these, that's pretty high probability trade. And this pattern right here is a 1, 2, 3 low. It makes a low, it rallies up, and the way I define a 1, 2, 3 low is basically it retraces only 50, or in this case 62% Fibonacci on the way down, and it doesn't even go more than a pip or 2 underneath there. And that's typically what a 1, 2, 3 low is. If the longer term trend is up, like this is, the weekly and monthly trend are one of the strongest. When it goes sideways like that and breaks out, you can get into these trades a little bit earlier, right here at 62 versus 82. So that's 20 extra pips. You get into that trade, and if you use the trailing stop, you might have got out of here with a small profit, got back in again here at 69, and notice the trailing stop got you all the way out here right around 30. So you made about 60 pips on that second trade. The upper containment bands usually are an area where the market reverses. It can sometimes go 15 to 30 pips above there, but it usually reverses. If you get, this is kind of like an opposite 1, 2, 3 pattern too, by the way, since I have it up here. This right here, notice it will retrace 62%. I actually prefer the 1, 2, 3 reversal patterns that only make it to the 50% level. They tend to be a little bit more profitable. But notice it reversed here and it kind of came right back down to the 1.618. Since I already had that on here, let me just review our Elliott two-wave trading method. Anytime you have a strong trend up like this with extreme strength at or above the 80 level, typically when currencies are above the upper band, they're going to make a two-wave pullback. So you draw your fibs on here, and it's usually going to go to the first or second fib target. You only want to buy these when they pull back and they don't go underneath the hourly. So the hourly was right there. You had the 1.618. This was a very high probability place to buy right around 108.06, and especially on a range chart. This is a 6 pips per bar range chart. Let's scroll that back and take a look. You can kind of see a little bit clearer that pullback right here. Came down to the 1.618, and it also has one of our 3-bar pullbacks. The first bar goes green, you buy it when it goes up above that, and you can see it kind of went from 108 to 05 all the way back up to 45. You know, you could have scalped it up, bought this little pullback right here, and made 10, 15 pips on the second trade, maybe 5 to 20 on the first one, depending on when you got out and so forth. Another one that was relatively strong today, and more importantly, the weekly monthly trend was up, is the Swiss. This is not one I leave running each night, but the Swiss yen also makes sense to be looking for buys starting the day off. And as you can see, this is a nice little flag pattern right here. You don't get many of those in the Forex markets, but when you do, it tends to be a pretty decent trade. I would draw my fibs from the bottom to this, and most of the time it's not going to go above the 1.618 without either going sideways or pulling back and then going sideways like this one did. But this is where you would get in, 58, put your stop right underneath this low. You're risking 10 or 12 pips. This is your first profit target at 80. So it's 22 pips away. You're risking 10 pips. And most of the time, if it went sideways like this for a couple bars, I would have exited half. And when it came up to this 1.618, got out of the second half. So I would have got out somewhere around 85 in this trade. Probably, let's just round up and say we got long at 60, made 25 pips. The currency meter pretty much telegraphed it. Another strong one was in New Zealand, and of course the Australian. I think I already showed the Australian yen during the day off. Went up. Notice it went right up to my Fibonacci profit target. When these are at and above the upper white 2.0 containment band, the price tends to reverse. Let's take a look at the New Zealand yen as well, starting the day off. Again, very strong move up. Went up about 40, 45 pips. You only need 10 pips a day, risking 2% of your account on any given trade to double your account every 2 months. So if you bought this breakout right here from underneath above the hourly and got out at this trailing stop right here at 82, it's almost a 40 pip move. You have an almost entire week's worth of minimum profit in one trade. Obviously, you're going to have losing trades of between 3 and 12 pips, but a nice 30 or 40 pip win can get rid of a ton of trades that just don't pan out.